But let's quickly, move on to our guest for the show. We have Nimesh Chandan, who is the CIO at Bajaj Finserv. Good afternoon, sir. Let me take your views on the market setup as of now. Where do you see valuations at the moment? And, in the global context as well, how are you looking at valuations given that the US 10-year is at 4.8% and overall markets are trading very close to their long-term averages?
Hi, Harsh. Pleasure to be on your show. Right now, I think the focus of the markets is shifting from economics to politics and geopolitics because the kind of events that are lined up currently as well as in the coming year, I'm sure they will cause some volatility. And unlike looking at inflation and growth rates where you can forecast, you may go wrong, but you still forecast in a range. Here, geopolitical and political events can bring certain uncertainty. And that's what markets don't like. So we believe in the near term, the markets will be volatile. Although we believe Indian markets are better placed, Indian economy and the corporate sector is better placed to weather this time, and the long-term outlook is good. And for investors, I think they should use this opportunity of volatility to increase allocations towards equity markets.
Right, increase allocations to equity markets at this juncture, but talk to us about what's really standing out from an India standpoint. We spoke to another fund manager yesterday. He was talking about how even when he went to meet investors in the US, there was a lot of interest and focus on India versus some of the other markets globally. Are you also seeing some of those trends play out? What are you, really speaking, and what are you really understanding from the people you are speaking with?
So, for many investors like me who have been in the markets for over 2 decades, will note that this time India is very uniquely positioned among its peer group countries in terms of growth, in terms of inflation, in terms of corporate stability, earning stability, banking and financial sector, real estate, which is a big part of any economy. We are much better placed than some of our peers, whether it's in the developed markets or in emerging markets. So naturally, there is a lot of excitement and inquiries from foreign investors looking at India. Also, the domestic investor coming through SIPs especially. SIPs bring a good discipline in terms of financial as well as emotional discipline, and that helps the country do better, the markets being more stable and less volatile compared to the others. Specifically, I think as IMF and World Bank and the estimates have come, India is one of the fastest growing countries within its peer group, within the large economies. And we are seeing, even within the corporate sector, a certain earning stability. I'm not saying that we are looking for very high double digit kind of a growth or so, but mid double digit growth, earnings growth is still much better than what other countries are experiencing. This is very unlike what we saw in 2003 to 2007, when there was a dozen other countries which were doing along with India. This time, India actually stands out very well.
Understood. And, when I'm looking at what you said initially, that investors should take advantage of the volatility in markets, it's been far from volatile over the last month or two, despite everything that's playing out. You're seeing the US 10-year bond yield move quite steeply higher. You're seeing it move from the 4.3% to the 4.85% mark. You're also seeing some amount of geopolitics playing out, but the markets have not corrected significantly. So are you expecting a correction to come in? Is that what you're alluding to? Also, if I can, try and couple a couple of points here, the mid and the small cap indices have also rallied quite sharply, 30% move on both those indices year to date. How do you view valuations? Are you still seeing some amount of opportunity, or are you seeing froth there?
Here we've seen some changes within the different constituents that are doing well in the market. We've not seen an overall sharp correction in India. That shows that Indian investors as well as foreign investors view India more favorably compared to other markets. However, we've seen some changes internally. So we've been cautious on the export side, and the recent numbers also show that because of global slowdown, the export companies are seeing some kind of downgrade in earnings, some kind of slowdown there. But the domestic economy is doing well, and especially the capex cycle is doing well. So we are within the domestic side, we are bullish, and specifically in banking financials, in capex stories like capital goods, as well as I think this is time to relook at consumer sector, and we are bullish on the consumer discretionary side. On the export side, probably this year will be slightly tough with a few more quarters of a slower growth and some downgrades coming in. Specifically, when we come to say mid cap and the small cap category, I'm not a big fan of generalizing about the entire category because yes, there have been pockets where valuations have moved up significantly, but I won't say that for the entire space of mid caps and small caps. Some of the companies or sectors which have been part of say infrastructure or capital goods or defense stories, those companies have seen a fantastic run up and possibly they have moved into a much higher valuation what they enjoyed earlier. Some of these infra companies are rallying after like almost 15 years of gap, right? So those probably valuations have moved up to reasonable or higher levels, but I won't say that for the entire category. And because the economic growth is doing well, I believe mid cap and small cap businesses will do well. You have to be selective about what you're picking up based on the valuations you're seeing.
Right. You spoke about consumer discretionary. Let me try and pull that point a little bit more. Want to try and understand your views on rural because that has not really recovered as well as most would want it to recover, right? And that recovery has been on the anvil since a very long time. It's been a stretched recovery. So two questions here. One is what are the factors that one needs to look out for to judge the recovery beforehand? And second is what's your view? When is the recovery going to come?
So last 2-3 years, we've seen rural demand being a bit subdued, rural economy not doing so well, but there are green shoots and we are seeing some kind of positive data now coming from the rural side that things are picking up in many surveys that we are seeing on the rural side. Also, typically, when you are entering an election year, and both state elections as well as the central election, there is a certain stimulus that comes to the rural area. There is a certain pickup in activity that comes in. And I believe this year too will not be very different. We will see some pickup coming here also. And because of the slowdown in the last 2-3 years, many of these companies have come to very reasonable valuations, which are catering to the rural demand predominantly. We've seen a kind of a K-shaped recovery, right, in the last 2 years, where we've seen certain premium items doing very well, but rural and bottom of the pyramid not doing so great. So we believe this will start coming back from here. We are already seeing some green shoots on that area. And we will see investors also warming up to it because now when they see a certain part of the market where capital goods have already seen a certain run up, people look for ideas where valuations are still very reasonable. And this is a very good spot to look at. Consumer discretionary also, you see the kind of growth we are seeing in employment, in housing, infrastructure, all this will feed into better employment and better consumption growth. So we are quite positive on consumer discretionary. After a certain point of time, the GDP also goes through a certain inflection point where you see per capita incomes doing well and more spending coming towards consumer discretionary side.
Right. You also have a debt fund. So want to try and understand your views with regard to how you view debt at the moment. Are bond yields, are rates now at a peak? Do you see them going up substantially from here, given that inflation has been stubbornly high? Also, the US as well as the India 10-year bond yield delta is at probably a 2-decade low right now. How do you view that? Is that a bit of a mismatch coming in there? Either the US bond yield has to fall or the Indian bond yield has to go up?
So our view is that within US, possibly as Fed has indicated, there may be one more rate hike left. But the debate will again, as I said, will move from how high to how long. So maybe we are at the peak or very close to the peak in terms of interest rates. And we may see a higher interest rates for longer because higher interest rates also act like a foot on the brakes of the economy. We will see some slowdown coming globally, especially in the US. And that will take care of the rest of the path that is left towards inflation. So there will be some sharp slowdown we are expecting in developed markets in US and Europe. India too, we believe that we are close to the peak of the interest rates and we will start seeing better from here. This is a good time for investors to lock in the higher rates when they are investing in the fixed income side, where without taking much credit risk, you are getting good safe bets, AAA portfolio at a very good yield, and you can carry this yield, and as well as through mutual funds, you can enjoy the capital gains that can accrue to you if the interest rate cycle, maybe 2 or 3 quarters down the line, starts turning.
Right, Nimesh, I've been flagged off and been told that we'll have to let you go on that note. But thank you so much for taking out time, speaking with us, giving us that perspective on a plethora of topics. It's been a pleasure interacting with you on behalf of the viewers as well. Thanks so much.